Okay, that's kind of the start time on my time, so I think it's time to begin. Hello to you all and welcome. My name is Kevin Anderson from Reuters Events, and I'm the organizer for this webinar titled Financing Net Zero Using ESG to Generate Impact and Returns, along with our partner JBS. There's almost 1,000 of you registered here today, so thank you very much for the great response that we've had throughout the last couple of weeks. And thank you in advance to our panelists, not just for their time today, but obviously in the hard work that's gone into prepping this as well. I just wanted to go over a brief bit of housekeeping before we begin. This webinar will be an hour long. We will finish on the hour with discussion between the panelists and a Q&A at the end. So do look out for the Q&A box at the bottom of your screen. The whole session is being recorded, so we will send you the full recordings within a week. Just a note on the questions. I did mention this to a few people who signed in a little bit earlier. There's a Q&A box at the bottom, which is able for any audience member to submit your questions via text, via typing, sorry. Do make sure to submit questions in there. We really like to have as many questions as possible for the panelists, and don't be shy. Don't wait to the end for the Q&A session. Please do submit questions throughout the webinar whenever they pop into your head, so we can make sure to get them to the panelists. If we don't have time, we can save those questions and we can give them to the panelists afterwards as well, and make sure you receive kind of some answers with the recordings. So without further ado, I think we'll move on to the webinar. So as an introduction, by 2025, there will be approximately 57 trillion ESG assets under management, demanding a viable net zero strategy. As ESG and net zero become ever more intertwined, investors must learn how to identify real projects that can deliver on net zero ambitions. Using animal agriculture sector as a case study today, we will understand in detail how to ensure real world impact whilst securing your required investment returns. Joining us today, we have some expert thought leaders in the area, and I wouldn't be able to do them justice by giving them an introduction myself, so I'll allow them to introduce themselves. Firstly, Cameron, can we start with you?
Yes, good morning, and thank you all for joining us today, particularly for those of you who are with us live. I'm sure most of our thoughts are east in Ukraine with what's going on this morning, so thank you for taking the time to spend with us. My name is Cameron Bruett. I'm the head of corporate affairs and chief sustainability officer for JBS USA.
Thank you, Cameron. And can we go over to you, Kim?
Good morning, everybody, and thanks for having me. My name is Kim Stackhouse-Lawson, and I'm the director of AGNEXT and a professor in animal science at Colorado State University.
Thank you, Kim. Can we go over to you next, Pratima?
Thanks, Kevin, and thanks, Cameron, for organizing the event. My name is Pratima, and I head the capital markets for CDP. For those of you who are not aware of CDP, we are a environmental best practice not-for-profit, and we essentially work with corporates and the financial sector to drive decarbonization and a nature-positive economy.
Thank you, Pratima. And Hervé, over to you.
Yes, good morning, everyone. Thank you, Kevin, for having me on this panel. I'm Hervé Duteil. I'm Chief Sustainability Officer for BNP Paribas in the Americas. I have it's a position I created about 8 years ago. Prior to that, I have a long background in capital market and derivative activities. BNP Paribas is a leading European bank with over 200,000 people, spread over 70 countries. And we've had quite a long history by now of bringing sustainable finance to the agri-food sector.
Thank you, Hervé. So we will move on now to our first section in the webinar. The webinar is kind of split into 3 sections, and the 3 sections essentially boil down to the first one of being why is sustainability important in the first place. The second is being around practical steps you can ensure the sustainability goals are actually made. And the third one being around how do investors actually make net zero decisions and what can be done to highlight that. So firstly, Cameron, I'd like to start with you. Agri can be sort of tended to be considered a slightly less green sector, but its fundamental place in society is very, very obvious to see. I had a sort of a 2-part question for you, which was firstly, why is sustainability really important for JBS? Why does it actually matter? And is it simply just kind of a case of doing good, or is there an actual commercial business element behind it as well?
Yeah, I would say, most agriculturalists would probably take umbrage with the statement that they are a less green sector. Agriculture is an industry that's been a part of society for over 7,000 years. And over time, farmers and ranchers have become more productive, more efficient, have dispersed products all across the globe to feed billions and billions of people. And so I think, over time, we've created the most modern, most efficient, most amazing agricultural system in the history of mankind. But, there's about 8 billion people on the planet today, and nearly 690 million of those go hungry, go to bed hungry. And so I think for many agriculturalists, we don't view sustainability merely as a credit and balance system on GHG emissions, right? We view it as this incredible challenge of how do we feed a growing, hungry planet in a sustainable manner that doesn't put the natural resources that are critical to agriculture at risk. And so given, that if you look at the US, most of the farms are multi-generational family farms. So, the average family farmer is looking at how do I maintain a sustainable operation and pass that on to the next generation? It's their livelihood and the future of their family at stake. And you're seeing, an incredible amount of action in the United States. So for example, cattle and livestock are generally at the point of the spear when it comes to sustainability criticisms. And just last August, the National Cattlemen's Beef Association committed to become carbon neutral by 2040, a commitment that, a decade ago would not probably have been possible. And then later that year, JBS, we committed to become net zero by 2040. The most, if I may say, audacious commitment in the global protein sector, given that much of the technology and innovation that will allow us to achieve that aim is not yet readily available. And other agriculture and retail companies are quickly following suit, making commitments to reduce their emissions and create more sustainable supply chains. That's going to benefit all of society. And so at JBS, we absolutely view sustainability as the ultimate determinant for our future success. We view it as a means by which to future-proof our business. We know that the way that agriculture is practiced today around the world will change, will transform. That's going to lead to more sustainable outcomes, not only for our business and our shareholders, customers, consumers, and team members, but for all of society as a whole. And so our net zero commitment and our focus on sustainability has kind of become the core pillar of our business because we believe there's no other option. With the challenge that we face with growing population, with the rise of the middle income class and their demand pull for more and more protein, we have to find ways to become more efficient, more sustainable so we can do our part to help feed people, but also to contribute to a healthy, thriving, and sustainable environment going forward.
Brilliant. Thank you, Cameron. I just wanted to touch on what you said there about how sustainability has kind of become a core pillar of JBS. I think we've seen that over kind of throughout the financial institutions as well, of sustainable investment kind of used to be on the side and kind of a thing that was a specialty, but now ESG is kind of being unfolded into every investment decision. Would you say that's quite similar in terms of JBS's operation, that a sustainability lens is kind of being applied throughout the organization?
Yeah, absolutely. Every investment decision, every operational decision is viewed through the lens of sustainability. And I can tell you, for years, while we took sustainability very seriously, we looked at it more through the lens of behavioral change. When we implemented our first sustainability program based on metrics and reductions in our plant operations back in 2015, that was largely based on behavioral change. But what we found was that many of the investments that are required to make serious reductions in emissions might not meet some of our internal parameters for return on investment or return on invested capital. And so in our 2040 net zero program, we've actually set aside $1 billion simply for in-facility reductions. so that the business units can have capital available to them that does not compromise their existing capital expenditure budgets. And we can invest in more longer term, longer range projects. And so, we're seeing significant investment both within the company, but throughout the sector. And we think, by making a commitment like NetZero, what you're doing is you're signaling to the market that a large player is going to be responsive to investment, is going to need investment, is going to require innovation and technological breakthroughs in order to achieve such an audacious goal.
Thank you, Cameron. It's really great to hear that kind of not just yourselves, but the sector as a whole is kind of pursuing the sustainable agenda in the right way. Hervé, I want to come on to you. So in terms of kind of first and second generation ESG investment, there's some key differences there, which we did touch on with Cameron, specifically going from best in class to the application of sustainability across all investment. Has that increased demand for ESG from an investor point of view?
Yes, and it is right that, as Cameron said, where they moved from, 2015 to today, from behavioral to basically completely holistic throughout all the operations of the firm. The same is true in finance. Sustainable finance that was truly born, I would say, 8 years ago in 2014. Sustainable investing had been around for long, but it was about making up some thematic portfolios, of incorporating some basic exclusion rules, and that was somewhat niche overall. But sustainable finance is not about making up portfolios, it's about financing companies. And when we started 8 years ago, basically we moved from the carrot 8 years ago to the stick, I would say today. We moved from the best in class to the minimum standard that needs to be met by all. We moved from niche to universal. So to understand it is we started 8 years ago with one first generation of product, and the first discovery, if I may say, of sustainable finance was that the minute you start labeling a use of proceeds, so whether it's in a bond format or in a loan, and that label, we started with green, but then we had multiple labels: green, social, sustainable, sustainable development goals or SDG bonds, gender bonds, vaccine bond, COVID-19 response bond, and so on and so forth. Blue bonds, rhino bonds. The list is endless. The minute you start tagging a label to the use of proceeds, you start uncovering pockets of investor demand that you did not know about, or that mainstream companies didn't know about before. So indeed, in those early years, obviously to put a green label, you need to finance something that is green. And for any given company, except maybe a wind farm operator, so X% of your balance sheet is green, and the rest is not necessarily, it might be neutral, or it might be hopefully in transition at some point. So initially those products was reserved to the best in class. We went to the best banks, best insurers, the best agri companies, best whatever you want. But then the second discovery, and actually it moved across asset classes. It was in supply chain financing in 2016, it was in loan in 2017, it was in bond in 2019, and in derivatives in 2020. The second discovery was that actually we could tie a portion of the interest rate to sustainability performance. So unlike the first generation of product where you really look at what the money is being used for, here you don't look at how the borrower is going to use the money, but instead you're going to look forward at future performance. And depending on how it is, the interest rate will move up a tiny bit, or a tiny bit up, or a tiny bit down. So that unlocked the use of sustainable finance to a lot of borrowers, because now you no longer need to have green use of proceeds, but instead to achieve greenhouse gas emission targets, reduction targets, water intensity reduction targets, percentage of women on the board, and so on. So this is really the revolution that has been going on over the last 2-3 years, I would say, at scale, making sustainable finance available to all, but with this caveat that basically, since everyone can access it, everyone should now start accessing it, and it puts a minimum standard on sustainability performance, at least on some metrics, to everyone. And if you don't, as time goes by, it will be looked suspiciously, if I may say, by investors of why you're not using sustainable finance yet.
Yeah, I like what you said there about kind of we've moved from the carrot to the stick, and now it would seem suspicious if you're not engaged in some kind of sustainability, rather than it being something for best in class. Now it's something that everybody should really be held to, and we create that benchmark. Kim, I'd like to come to you next. Why would sustainability be considered important within the context of AGNEXT, and what is the science saying about the emissions from agriculture as well?
Yeah, so I think I'll start out first just by explaining what AGNEXT is. So this is a new initiative at Colorado State University that sits between the College of Agriculture and the College of Vet Med and Biomedical Sciences. And it's a provost initiative that will add 12, and if you include myself, 13 tenured faculty members focused on developing solutions for sustainable animal agriculture production. So I think you've heard, certainly from Cameron, as he described some of the challenges that we certainly face in the US, but more broadly globally, is that we've made these wonderfully audacious commitments that need to be made and will establish transformational change in the supply chain. And yet there's a gap, right? There's a gap in the technology, there's a gap in the science, there's a gap in the execution of tools. And so CSU was really insightful, and they actually started this 2 years ago, and have put significant funds to really bringing those experts to assist in trying to figure out, what are real world solutions and how do we scale them? Because I think, when we think about these animal agriculture systems, as has been mentioned, they're generational. They're incredibly resilient on the landscape. They manage vast landscapes that are really important, right? Not just from a standpoint of food production, but from a standpoint of ecosystem function. And we have to ensure that while we go after audacious greenhouse gas mitigation strategies, that we keep those landscapes and social networks intact, right? Because they are feeding the masses. And so we need to, really do a good job balancing our needs to meet climate goals and to meet our nutritional needs as a society. So your next question was, what does the science say about emissions from agriculture? So in the US, agriculture, and this would be scope 1 emissions, are responsible for about 3.8% of our animal agriculture, is approximately 3.8% of our greenhouse gas budget. Now, of course, those percentages shift, right? If you're looking at it from a global perspective, or you might be in a different country. But really what we see is that emissions from animal agriculture are increasing. That should not surprise any of us, right? We are producing more food, so of course they're going to increase. We see the footprint of these systems decrease, right? So to Cameron's earlier point, we have developed extremely efficient systems, but we know that to meet our greenhouse gas goals, it has to be more than just those efficiency gains. There has to be additional innovations created to reduce absolute greenhouse gas emissions. And that's where the science gets hard, Kevin, right? So we actually just in the last 4 to 5 years as scientists have the technology to actually measure in real time greenhouse gas emissions from cattle, for example. And we all know that cattle specifically have been targeted for their enteric methane mitigation or methane emissions, and yet we really have only had the ability to measure them in their natural environments for a very limited time. And even that equipment that exists today only measures 24 head at a time, right? So you can imagine asking an operator to make a change in their operation based on relatively small numbers, right, of research and analytics and all of these things. So we're really passionate at CSU about working not only with our private partners, but also with our producer partners to ensure that we can develop mitigation strategies that are real world, scalable, actually going to result in, some sort of emission reduction, but also really focus on the resiliency of that supply chain, because we know that that's multifaceted. That resiliency is not just about carbon. It's not just about water. It's not just about economics, right? It is a big system, and it's critical for all of our futures.
100% agree, and there's a couple of follow-up questions that I really want to ask you there, but they actually
Sure.
fit nicely into they fit very nicely into the next session. Then I don't want to step on the toes of the next session, so I'll make sure to ask them then. But thanks very much, Kim. Pratima, I really wanted to come to you next, and just ask: are there any kind of other things that you've seen, perhaps maybe across similar sectors? I know that CDP, you have a lot of examples of kind of climate resilience, and specifically with regards to the best steps to pursuing climate resilience.
Yeah, absolutely. And I think just hearing some of those, some of the work that the other panelists have been doing, I think there's a lot of parallels that I can draw with the data that, we already sort of work on. I mean, just kind of taking a step back though, I think it was the World Economic Forum that said that, half of the world's GDP is moderately or highly dependent on nature. And that in itself has risk with biodiversity loss, as well as degradation of economic ecosystem services, right? Now, of course, there's been a huge primary demand for agricultural products because of, just pure base demand, but also, the rise in income. And that's also led to inefficiencies in the production systems, which is kind of, manifesting in unsustainable practices. And it's also, manifesting in wastage within agricultural systems itself. Now, how companies are sort of working on it, I would say they're probably working on it in two aspects. One is taking stock of their existing systems and trying to see how resilient their business operations are to climate change, to any other stress factors such as deforestation or with respect to water. And then taking the process to decarbonization. So it's quite important that they kind of figure out the stability and the resilience of their direct operations first before they take that journey to decarbonization. And this is kind of, if we've got several examples. We've got a paper company in the US that recently reported and talked about the increased extreme weather events that have led to issues with sourcing of raw materials such as wood chips near their manufacturing facilities, and they've started to sort of adapt to that. So they've invested in real-time mapping systems that will actually help with securing the right amount of supply for their raw materials and make it a little more resilient to extreme weather events. That kind of example is what we're seeing mostly within the responses that we get, that the companies are actually fact-finding these stress points within their direct operations. I think the big question mark is still the supply chain in itself. And our data shows that, if you look at the 600 odd companies that respond to us in our forest questionnaire, about half of them don't engage with their supply chains at all. They plan to do so, but they don't do as of now. And even amongst the ones that do engage, have sort of just started that at the first sort of tier 1 level of suppliers. And that's perfectly understandable because the journey to engagement has just started. But what that actually means, and let's take the example of a non-agri company, but that relies on agricultural products. So let's take the automotive industry. Now, for tires, they depend obviously on rubber as their source of raw materials. 85% of the farmers are smallholder farmers, about 6 million of them, and predominantly based in Southeast Asia, one of the most vulnerable regions to climate change in the world. Engagement with smallholder farmers is obviously highly expensive. It's somewhere down the supply chain. And it's difficult at this point to develop that level of traceability, develop that level of due diligence to actually ensure the level of resilience that you're looking for. So what that actually means in terms of like summary, if I were to kind of put that data together, is they've started on the journey, the corporates, they're working on direct operations, but financial risk within the supply chain is very likely underreported and underestimated.
Thank you, Pratima. And again, there's kind of a couple of questions that I want to ask you there, but I think it slides us really nicely into our next session around kind of the practical uses and what are the practical steps we can really take to have a real impact on reducing emissions, but whilst also ensuring there's that commercial element to it. There's that investment returns piece, which is important. So Kim, I actually wanted to come back to you there, and I wanted to ask you, from that practical standpoint, what are the kinds of things that companies can do to reduce emissions while still ensuring that commercial viability? And are there baselines, are there benchmarks that needs to be set or met? I know Hervé touched on kind of ESG being used as something that everybody should be doing now, so that kind of sets a natural benchmark. Are there any kind of other benchmarks that you've seen as well?
Yeah, so I think, in the animal agriculture space, specifically as it relates to greenhouse gas emissions, we have benchmarks that are based on models, and those models they're great, right? They're not bad, but they're also not super tangible, right? So if you're then asking a producer to implement a mitigation strategy on their own specific landscape, it likely is not going to change the scope 3 modeled number that would feed into a large company, certainly a large food company, right? So essentially the benchmark data that we have is not granular enough if we implement a change to see a result all the time. And I think when we think about that, and I loved Pratima's description of scope 3, because it's certainly, I think, absolutely a gap, and yet it is such a hard, it's a difficult path to navigate, right? Because oftentimes these supply chains are not vertically integrated, and that may be a really good thing from a resilience standpoint or from an economic standpoint, right? And so actually working with those supply chains to encourage adoption of mitigation strategies becomes the real challenge. First, we've got to develop the mitigation strategy, right? So enteric methane is a really good one to talk about. Usually, there's a couple options. We could potentially breed for animals that have, produce less methane. We could feed them things to reduce less methane, but we still need these sorts of win-wins, right? Because who then pays for the incentives to have that supply chain that may not be vertically integrated or may not be touchable by these larger food companies? Who's going to incentivize that adoption if there's not another economic win from the mitigation strategy, from the solution, right? And so that becomes the hard part, not just tracking the emissions in scope 3, but also actually implementing or helping to implement that transformational change. And the other thing that I thought was really insightful about Pratima's remarks were, these supply chains are challenging because they're their own social dynamics. They have their own social dynamics. They're people, like they're people, they're cultures. They are working within their own specific region and ecosystem, and they might have different challenges that are presented to them. And there's not a silver bullet approach. So even in the US, which arguably is much less complex than South America, for example, what might work for, let's just use beef again, a cattle rancher in Florida is not going to work for a cattle rancher in Colorado. They are two completely different ecosystems and regions. And so that further, I don't think it's impossible, but it further complicates the challenge, right? Is that we really need strategies that focus on outcomes, that are adaptive, that are inclusive of different social dynamics and social networks, and are also, to Pratima's point, focused on that economic element, that economic risk, right? Because a producer may not be willing to take that risk either. And so really, these are, multifaceted challenges that I just, really warrant intentional thought and structure. And, we've really got to come together to figure out what the best solutions are.
Definitely. And I think what you're saying there is you're touching on a really nice point, that ESG sometimes can get split into E, S, and G. And obviously this is kind of financing net zero and talking about emissions. Like we obviously have an environmental lens here, but in reality, those environmental impacts have huge social impacts as well. And I think what you're saying there about kind of different supply chains having different kind of social impacts and social importance within their sort of local economies is massive as well. Cameron, I wanted to come on to you and speak to you quickly about kind of how does a corporate like yourselves look to reduce emissions? Are there kind of feasible takeaways that you might use from a piece of research? I know you guys have been doing some research funding recently, and that's kind of been a focus for you. And how do you take that research from research and then place a commercial lens on it to really make it a part of your operations as a business?
Yeah, I think to Pratima's approach, we try to take a very practical approach. So number one, looking at what's directly under our control, right? So obviously, we operate a lot of facilities around the world, and each of those facilities has a footprint, right? And so the first step we've taken is to look at reducing our operational footprint, looking at scope 1 and scope 2, okay? And so we have a very simplistic process within the company. We like to keep things simple so we can advance the ball quickly. And we have a very simple process whereby plant managers, plant engineers, plant environmental teams submit projects for review from our senior leadership team. And then we judge those projects, not based on the traditional metrics of return on invested capital, but we look at 3 primary areas, right? So we look at internal rate of return, but then we look at dollars invested per metric ton of GHG reduced. And then we look at the total metric tons that would be potentially reduced from investment in that project. And it's been wildly successful. So since Q3 of last year, we've approved over 100 in-plant projects and allocated or budgeted over $65 million just since Q3 of last year. And if all those projects are successfully implemented, and we know that some won't, it's just the nature of the business, we would achieve over 10% reduction in our scope 1 and 2 emissions in our facilities. But to Pratima's and Dr. Kim's point, scope 3 is the big challenge, right? And the only way we're going to get at true innovation in our supply chain in a way that empowers farmers and ranchers, that empowers these ecosystems that we've discussed, is through groundbreaking research. We have to uplift. So I think, if you look back when roundtables for sustainable palm oil or soy were formed originally, they were looking at a certification process whereby there were winners and losers. You either defined as sustainable or you were not, right? And then you became a part of a corporate supply chain or you were excluded. And this could have, potentially devastating impacts on smallholders. And so when we looked at forming the Global Roundtable for Sustainable Beef, we wanted to have a more holistic solution, right? Where everyone could participate in the sustainability journey, understanding that people would be at different points along that journey. And so as we look at our net zero commitment, we don't want to come out with just simply a certification program where some producers are excluded and others are excluded. That may be the easiest way for us to protect the company's reputation, but it's not what's best for agriculture. It's not what's best for these ecosystems. We need people to be encouraged to join this sustainability journey, to be incentivized to join that journey, and to be a part of the collective solution. So, since last year, we've invested over $1 million in academic research, some with Dr. Stackhouse at CSU, looking at a net zero beef roadmap here in the US. We've funded research at the Food and Farm Agriculture Research Foundation, looking at the Greener Cattle Initiative, looking at feeding regimes to reduce enteric methane emissions. But there's going to have to be just tremendous amount of research, whether it's with our packaging suppliers or our livestock and feed providers, to try to bring down those emissions in the supply chain. It's where the large majority of the emissions for any corporation are going to exist. And it's the great challenge for all of us. I think what's encouraging is you are just seeing an explosion in research, right? So at my alma mater at Tuskegee University, great research going on in forestry and livestock. At Texas A&M University, Michigan State, the University of Nebraska at Lincoln, and then arguably, I would say the most preeminent sustainable livestock research program in America is right up the road at CSU under Dr. Stackhouse's leadership. And so I think over the next 5 years, over the next decade, we're going to have a very different discussion, because not only are we going to have the data available to us, but we're going to have real scalable solutions that are going to allow us to make a difference.
Brilliant. Thank you, Cameron. I like the fact that you gave a lot of examples there, especially in terms of the kind of the research funding that you're looking to put in. I know you said that and I didn't want to put you on the spot about this, but I know our audience loves a practical tip and kind of practical solutions to the issues of the day. And I know you mentioned earlier that you said you had 100 in-plant projects that were currently under review. Is there anything you can tell us about that in terms of kind of the scope of those projects or what they're looking at? I know, as I said, our audience loves a kind of an actual practical project to get their teeth into. Like I said, if you can't tell us, then absolutely fine, but it'd be great if you could give us a little more insight.
No, there are projects that you would you could probably guess, right, given the current technology available. So we're looking at large solar installations. We're looking at heat recovery systems. We're looking at covering anaerobic lagoons. But what's more important, I think, than the actual projects themselves is the enthusiasm it engenders in the organization. Okay, so for years, a large corporate would make sustainability commitments, correct? And a lot of that would have to be done through behavioral change. The classic turn off the lights when you leave a conference room, where you leave your office building, or look at your water use and turn off taps. But now when you go to over 100 environmental engineers in the company and you say, I have $1 billion to provide to you to help you meet your GHG emission goals, and you don't have to compromise that capital with what you need to do to operate the business, whether that's installing a new line for a key customer or necessary upgrades for this facility. So in essence, it's free money. It's not free to me because it's coming out of budget, but it's free money to the facility to invest in a more sustainable future. And it's leading to very creative ideas. And then what you do is, when you get all these folks in a room or on a Zoom call and they're discussing the projects they're implementing in their plant, it quickly becomes scalable, right? And then you can do those projects across multiple facilities at a reasonable cost. And I think the same thing is going to happen in supply chain. Dr. Stackhouse pointed out, one of the projects we're working on is looking at, regional grazing models across the US, because the way cattle are raised in Florida is much different than Colorado. There's different ecosystem, different land management challenges. But I think the same paradigm will occur in supply chains. As more investment, more technology and innovation is brought to bear, you're going to see scalable solutions, right? And they might not be scalable across an entire continent or across multiple regions, but they're going to be scalable to the point to where we can actually start to get to those details and really show progress. Because today, that's the big challenge. Unless we're going to go into identity preservation for every kernel of corn or for every hoof of cattle, the cost of that will be exorbitant. It's not reasonable, and it's going to price people out of the market very quickly. And consumers, while they love food, they also love the price of food. They like to keep that price down. So how do you create a system where you're not creating disincentives for the farming community, but you're actually incentivizing people to be a part of that solution?
Brilliant. Thank you, Cameron. Yeah, I think I would definitely agree with that last point you said, that we love food, but we love the price of food as well. But it's great to kind of hear some practical tips and some steps that you're actually taking to kind of engender ESG as well, and kind of reduce those emissions, rather than that just sort of esoteric discussion that is sometimes had between organizations. I am conscious of time, so Pratima, I did want to move on to you, and I kind of wanted to combine a couple of the questions I had for you. And one of them was kind of, when we're thinking about that transition that needs to be made, what's really happening with the corporate response? Again, at CDP, I know you kind of cover a lot of different sectors and a lot of different organizations, so it'd be interesting to hear what's happening on the corporate side. But I also want to ask, what have you seen from the investor side, and is there kind of types of linked funding which has allowed investors to fund a net zero strategy as well?
Yeah, I think from the corporate side, there's probably sort of, from a risk angle, there's probably sort of 3 or 4 areas that corporates really sort of aim for when they start out the journey. One is obviously the reputation and brand value, and then how that transforms into business strategy. And that's really just the starting point of the journey. I think 3 key sort of transition costs really kick in quite rapidly after that. One is obviously regulatory changes, and the higher impact you are in an industry, the more attention that's being paid to it. But bringing in that supply chain angle as well, we've seen corporates grappling with that a little bit, and I think that touches upon the social aspects of it as well. So just to give an example, there is a company that's made certain sustainable forest practice commitments, and as a result of that, they want to buy only sustainably sourced palm oil at a certain point in time. Now that's a great commitment to have, right? But what has happened is the region that they source from, the local government has started issuing permits to smallholder farmers to in areas which are forested to deforest and grow palm oil. Now, a company that has already made that commitment and has publicly communicated that commitment, it's suddenly a question of, well, can you increase the traceability? And if you cannot, are you going to move entirely out of sourcing from that particular region because you might be actually promoting deforestation with the sourcing of palm oil? And then what happens to the suppliers that you've been working with who are not doing these practices? So there's some very practical social elements that come into this equation. And so, a commitment does have its own practical challenges. And the third area is, of course, increased production costs. The minute you start increasing, traceability and due diligence of this traceability, your costs are obviously going to rise. And so what some companies are starting to do and starting to think of is, can we consolidate this traceability across certain number of suppliers, which will then kind of keep the production costs low. And at the same time, then can we, start looking at elimination of waste within the supply chain that is traceable. So, it's more of a bringing down wastage, but also reducing production costs. And then in another area that we're seeing in terms of actual engagement, where, it's sort of like a win-win. A coffee chain company, you probably know it, what they have done is they've made a public commitment to supply 100 million trees in 10 years, which, specifically are rust resistant, have more yield for coffee farmers that they can work with through their supply chain. So, it's actually kind of building towards resilience of the supply chain, but actually increasing the supply to them and, helping keep the costs low, but also, working towards the business demand.
Thank you, Pratima. And again, I think those kind of practical steps, those steps that you laid out, I think are really important and exactly what our audience wants to hear from. Hervé, I kind of wanted to come to you next in terms of considering different options of funding, and what are the different sort of types of things that investors look for. Obviously, Pratima touched there on practical steps, and I was wondering, from an investor's point of view, are tactical KPIs more important, or is there a more of an enterprise level, a global organization-wide strategy that investors look for? And does that kind of impact the cost of capital as well? Are you looking at both levels, or is it just one?
So there is today and there is tomorrow. Today, so if you're talking about structure, KPIs on sustainable finance transactions, those sustainable finance deals are bought by traditional investors as well as sustainable investors. First of all, sustainable transactions are not solely bought by sustainable investors. quite the contrary to some extent, and the regular investor base. So today, the regular investor base will look at a sustainable transaction the same way they would look as a traditional transaction. The sustainable investors, on the other hand, will place a lot of scrutiny on making sure that what is material is properly addressed. So that can be in two ways. Sometimes when companies, and I'm really thinking of the agri-food sector here, but when companies have a truly public, comprehensive strategy out, public commitment, which, for example, are validated by the Science-Based Target Initiative, the SBTi. When they are intermediary targets, it looks comprehensive. Your set of KPI doesn't have to be over the top, because investors get the feel that it is properly addressed. Otherwise, today they would like to see probably a mix of, if it's one KPI with not an overall strong strategy as backdrop, they would like to see a combination of KPI, probably with use of proceeds. Because at the end of the day, and as Pratima said at the very beginning, what is key is to make sure you cover your entire value chain. And in the agri sector, and I'm thinking of Brazil in particular, where cattle ranching is very important, as well as soy production, we know that the bulk of the problem is not in the direct, but the indirect supply chain. So this is what has to be addressed at the end of the day. Not we want to look at absolute emissions, not solely carbon intensity. We want to see at indirect as well as direct supply chain. That goes through traceability. So any metric that relates to some of these, what is the percentage of your indirect supply chain that is traced along the years, it's a first marker, if you wish. So that's what matters today. Either through KPIs or whatever you put out, plus the overall strategy, make sure you address the crux of the problem, which is the indirect supply chain. Tomorrow, not only sustainable investors, but regular investors will pay attention to those same topics and metrics. And the reason is, as we said earlier, as ESG is becoming universal, as ESG is becoming, some ESG metrics are becoming a minimum standard to meet, the level of fluency as well of investors will increase. And everyone understands that investors will become more and more selective over time, which means that there are transition risks on the horizon of carbon intensive industries. Some sectors, rather than others, are more prone to it. And of course, your own positioning within that sector is important. But if not well played, access to capital and cost of capital in the next 3, 5, 7 years, who knows exactly, will be disrupted for some. And this is certainly the way investors, but as well banks, are looking at it from two angles. One is the traditional credit angle, where since we understand that transition risks are on the horizon, it means you have climate-related financial risk on the horizon that have to be taken into the credit analysis. But there is a second angle as well, which is the commitment that most of us have made to align our portfolios to a net zero pathway, which means we do have to reduce the carbon intensity as well as the finance carbon emissions of our portfolios, and we'll have to be more and more selective with our clients over time if they don't transition along the same journey.
Brilliant, thank you, Hervé. Sorry, I just wanted to quickly come to Dr. Kim and then to Cameron. I am conscious of time with the sort of the Q&A session there at the end as well. If just to let the audience know, if we're unable to get to your sessions questions, we will be able to put the questions to the panelists after the webinar, and then be able to send out those send those out all to you as well as kind of an extra bit of something for you to take away from the day as well. So Kim, I wanted to just ask you, kind of with scope 1, 2, and 3 emissions needing to be considered, what role does the supply chain play in informing a net zero strategy, and why would that be important to relay to investors? Obviously, this is something that we have touched on quite a lot throughout the webinar. Obviously, Pratima's touched on it a lot there, especially sort of in the beginning as well. And I'd be keen to hear your thoughts, yeah, especially on why it's important to relay that to investors at the end of the day.
Yeah, so I think when we really think about, supply chain greenhouse gas emissions, we've got some gaps in the animal ag sector that we've talked about quite a bit. So just to make this, pretty short and sweet, I think we need to be able to quantify metrics. We've got to be able to look for scalable real world mitigation strategies. We've got to be able to verify those mitigation strategies work. We need to set up demonstration sites because that's key for adoption, right? We've got people have got to be able to see this in real time, and that can kind of serve also as a quantification, verification of those scalable mitigation strategies. And then at the end of the day, we have to understand cost, right, of the implementation, so that we can figure out some sort of, ideally a buy-sell market, right, that would pull this all the way through and truly transform the supply chain to the adoption of these practices that would get us at the efficiency metrics, but then also those absolute reductions, right? So we're a ways from having all of those things kind of lined out, but I think that, again, Cameron mentioned this, the energy that is around this right now is really exciting. And in the space of kind of science and academia, this is one of the only spaces where we're actually seeing true public-private partnerships, and I think we're going to need them to really execute a net zero economy.
Thank you, Dr. Kim. And I think, yeah, what you said there is really interesting around the kind of the true public-private partnerships. I think it's an area which lends itself so well to that. Cameron, I really wanted to just come to you quickly about kind of the way you get your net zero projects funded. I know you guys have a sustainability linked bond strategy, and I think it really links nicely into what Dr. Kim was saying there about quantifying things and actually being able to see the impact and having that evidence. What was your sort of reasoning for using the bond route, and a little bit more about kind of the concrete steps as well?
I think when we discussed it internally, Kevin, there's this tacit recognition that it's not enough to just say we're going to do something by 2040. A lot of people have done that. We wanted to demonstrate that we're actually going to put real investment behind the commitment. And so we've actually issued 3 sustainability-linked bonds, and they're all tied to metrics to reduce greenhouse gas emission intensity in scope 1 and 2. And so we're very pleased with the oversubscription of those bonds. Our global bond was oversubscribed by 10 times. It had over 280 investors involved. But we think it demonstrates both externally, but really importantly internally, that we're going to hold ourselves accountable, because each of those bonds has a coupon step-up rate penalty if we're not meeting interim emission reduction targets. And we think it's a practical way to kind of start this journey, both internally and externally, towards really getting at absolute emission intensity reductions, right? But again, we have to pivot towards the supply chain as well. And so because there are so many unknowns and gaps, as Dr. Stackhouse has outlined, it might not be responsible for us. It might not be meeting our fiduciary responsibility if we were to make some very aggressive claim in the scope 3 landscape in a bond framework, right? But because it's not a green bond, it's not a bond where the proceeds are absolutely tied to individual projects, it gives us flexibility to use those funds for a lot of scope 3 related projects while meeting the commitments we've made in scope 1 and 2, which are very important for the organization. But we understand, the entire supply chain is going to have to be involved. So in Brazil, for example, they issued a green bond tied to producers signing up for their green platform. which gets at both direct and indirect suppliers. And if a certain threshold is not met, there's a coupon step up right there. So I think, sustainable financing is going to be incredibly key to meeting these goals. I saw some reports where, ESG metrics can be a greater determinant of return on investment than debt to equity, than leverage. And so this landscape is moving so very quickly. The sustainability linked bonds in the US, while, far underpacing that in Europe, they're exploding. And so I think there's just, there's enthusiasm, there's intensity, there's excitement, and there's investment, right? And so, I think Larry Fink said that the decarbonization of the economy is going to be the greatest investment potential opportunity of our lifetime. And if he's correct, then I think many of these aims will be achievable because it's going to take Dr. Stackhouse, it's going to take finance, it's going to take investment, it's going to take private sector action, it's going to take all of us working together to meet these audacious goals.
Appreciate that, Cameron. Thank you. I think there's one question that came in that we'll be able to get to. Dr. Kim, I know you have a hard stop, so apologies for slightly overrunning. But is there a worry that we are too focused on carbon, climate, and net zero that we'll lose sight of the greater ESG issues? It says stuff about kind of net zero seems to lose sight of the other aspects related to underlying problems. Pratima, maybe I'd like to start with you there, just in the idea that obviously we've touched on social issues quite a lot throughout the webinar, and that the climate and the E part of ESG cannot ignore the social part. They're fundamentally intertwined. So I just, if you're able to expand on that a little bit further and say how it's important to keep that at the front of our net zero strategies, I'd be really interested to hear your perspective there.
The question was to me.
Oh, sorry, Hervé, to Pratima.
I think from a net zero perspective, the governance does fit in. Because a net zero is essentially something that is a business strategy, and it has to fit into your enterprise risk management framework. Otherwise, it's not going to happen. So if it's going to fit into your enterprise risk management framework, then your board has to be informed. Your key management team has to have KPIs that are linked to the strategy. So I think the governance element does already fit in. The social element is tricky, and I think that is something that we've sort of spoken about it through this panel. But I think that is something that I would say companies are trying to figure out and deal with. If you take Hervé talked about the Science-Based Targets Initiative. CDP is a co-founder of that initiative. One of the requirements of having your net zero target validated by the Science-Based Targets Initiative is that you have to engage with your supply chain, especially if your scope 3 emissions are 40% or over of your overall emissions. So that does get looped in. We've worked on certain sustainable financing strategies that are linked with supply chain. So for example, we developed a supply chain linked sustainability product with Walmart and HSBC, which basically incentivizes the suppliers if they provide a certain level of information and meet a certain level of targets that meets overall Walmart's goals, they get a certain incentivization on their trade financing. So there are these kind of elements that are built into the net zero plans that have a social focus. But I would not say at this point, I think it's a bit ambitious to say that they're all fully aligned with net zero goals.
Agreed. Yeah, I think it's quite difficult to align everything, but to say that everything is aligned fully at the moment. Dr. Kim, I know you have a hard stop, so I'd like to come for you quickly for a quick comment, and then we'll go to Hervé and Cameron, and then we'll obviously have to end the webinar. But yeah, if we could come to you for a quick comment, Dr. Kim, that'd be great.
Yeah, so I agree with everything Pratima said, and the notion of the question as well, right? I mean, I think when we think about these supply chains, especially in animal agriculture, they're built off of our landscapes and our ecosystems, and those things don't exist independent of other environmental aspects and other natural resources besides carbon, but they also don't exist without people and rural infrastructure and rural economies. And, all of those things are so intertwined. And if you add the animal component, animal welfare, animal health, these are really complex systems. And that's some of the work that JBS has asked us to do in this road mapping planning, is not just a roadmap to net zero, but a very intentional look at using some systems modeling and causal loop diagramming at unintended consequences of some of these suggested change options, right? How do we get there? Well, what do we need to be very careful of as we step down that path? And so, so I think we need to always keep that in mind. That's our job. That's what being a sustainability professional is saying that, yes, we have a huge challenge, but it has to be done in the right way, where we don't create even bigger problems by solving one.
Definitely. Cameron, did you want to kind of jump in there just off of?
Yeah, we had some very serious discussions when we decided to go down the path of net zero, which was basically this: net zero is consistent with our sustainability strategy, but it's not our sustainability strategy, right? And around the same time that we made that commitment, we made the commitment that you can conveniently see behind me here, our JBS Hometown Strong program, which is committing $100 million to our local rural ag communities across the United States and Canada. Right, investing in refurbishing libraries and schools, or building new recreational facilities, or giving $1 million to the YMCA, or investing millions of dollars in affordable housing in our local communities, because that's a part of sustainability, right? And at the same time, we announced our Better Futures program, an initiative whereby all 67,000 of our U.S. team members can go to community college for free. And not only them, but their dependents can go to community college for free. So we partnered with over 50 local community colleges across the United States to provide that economic and academic opportunity. And then, as Dr. Stackhouse points out, every day in our facilities, we have to monitor and promote animal welfare, humane handling, food safety, and environmental goals well beyond emissions into water use and local environmental justice issues. So, net zero is very important, right? It's a common cause that I think we all should rally around. But much like the broader discipline of sustainability, there's always trade-offs, right? And we can't focus on net zero at the expense of other incredibly important initiatives that impact people's lives. And at the end of the day, as a food company, every day we feed people, right? And so we've got to produce safe, nutritious, affordable food products for people as well. So, none of this is easy. It's a huge challenge. And again, it's just exciting that so many people are willing to take it on.
Brilliant. Thank you, Cameron. And yeah, I agree. I think I agree that although the massive challenges, the uptake from the market, public, private, everywhere, I think is commendable and really, really motivating to see. And I think it all helps us all push in the right direction. Hervé, did you have any last comments that you wanted to kind of make on that point before we wrap up from your point of view?
No, just on the social, I don't think net zero, at least net zero, is not a distraction to the social. It doesn't necessarily solve it. Solving the social sometimes is key to get to net zero, which is good news, because if you want to get net zero, you need to figure it out to make it work on the social. But I don't think it's a distraction. So that's just the point I wanted to make. The investors, there is a huge appetite actually for products that would tackle social issues. We all started with environmental and net zero topics because the metrics are much easier. And also it's sometimes there is the fear that some social topics are the tree that is hiding the forest of problems. But long story short, there is interest in the investor community, strong interest actually for social topics, but net zero is not a distraction.
Brilliant, thank you, Hervé, and thank you to all of our panelists today. Unfortunately, that's all we have time for. We will have to wrap up. There obviously is a huge amount of questions that have come through. There's at least 20 questions. There's a bunch have been posted in the chat as well, which I've been making sure to save. So what I wanted to say was just thank you very much to all of our audience for attending. Thank you very much to all of our panelists, not just for today, but all the kind of the hard work in putting your presentations together and all the prep that we've all done together as well. There will be a full audio replay and full audio and video presentation, which will be shared with everybody within a week of this webinar finishing, and yeah, we'll obviously have a few on the horizon as well. But thanks very much again to Cameron from JBS. Thank you very much to Dr. Kim from CSU. Thank you very much to Pratima from CDP. Thank you very much to Hervé from BNP Paribas. I think everyone will agree we've had an amazing discussion. There's lots of questions which I will definitely get over to all of the panelists. Look out for those answers when we send the recordings around. Thanks very much again, and we'll see you soon.
Thank you.